Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing stocks with X dividends next week. Now, I just recorded this. Turns out my mic was not on, so I actually have done the whole process already. I'm going to go ahead and share with you guys what stocks I got and why they were selected. Then we're going to go look at how long they've been growing and increasing their dividend and a couple other their financial metrics. So if you're brand new to the channel, I do make stock market, real estate, and dividend related videos. If you have not yet subscribed, hit the subscribe button, hit the little notification button because I put out content every single week. Now let's go ahead and get into it. So right now, what I've done is I went over to dividend.com, selected X dividend dates, punched in common shares, set the dates for the 24th through the 30th, which is next week. I then searched, put them in order from the highest rating. 4.8 is this week's highest, and I use the DARS rating system to measure these stocks. It goes over, measures their strength, yield, attractiveness, reliability, uptrend, and growth, and then rates them at a 4.6 to 5 is highly recommended. 3.6 to 4.5 is recommended. So what I did here is I grabbed all the stocks that have a 3.6 rating or higher, and if we head over here, I copied all of these over here and put them into my spreadsheet. So all the way down here, there were 68 of them, I believe. Put them into my spreadsheet over here. There are 68. Yep, there were 68 stocks. Now, a few of these are not qualified dividends. Some are unknown. Some are qualified dividends. But if you buy these within a Roth IRA, it doesn't matter whether it is a qualified, non-qualified, because it's tax sheltered. If you're buying it outside of a Roth IRA or IRA, for example, just an individual account, you will get taxed at these unknowns and not qualified at your regular income tax, whereas the qualified dividends, they'll get taxed a little bit less depending on what tax bracket you fall into. So definitely do your research there as to what kind of account you're trading and whether it's qualified or not qualified. So once I've done that, I did this whole process already. So I took 68 stocks. I measured them against the current S&P 500 PE ratio, which is 25.4. So I normally I select anything below 25 and below and keep them within my screening process. And then next thing, I went over and took a look at dividend yield. I removed anything with a dividend yield less than 1.5. So the stocks that we have here now have PE ratios less than 25 and dividend yields greater than 1.5. That left me with the number of stocks still. So the next thing I did here was I went and looked at revenue, net income, and free cash flow for all of these stocks here. And each of these stocks had increasing revenue, increasing net income, and increasing free cash flow over the last 10 years. Here, Lincoln Electric, this has been increasing by 1.9% in free cash flow, 1.6% in net income, and 1.3% in revenue over the last 10 years, year over year. That's not enormous growth, but it still made the cut. We have Republic Services here. We had very high net income, up 1.63 thousand% over the last 10 years. 22% increase year over year for free cash flow. 21% increase in revenue year over year for its revenue there. Very nice growth there. State Street Corporation. We have free cash flow up 348%, or 34% year over year in free cash flow. 20% in net income over the last 10 years, so that's about 2% year over year growth in its net income and 1.5% in its revenue. So again, not amazing. That's very similar to Lincoln Electric, steady growth. We have U.S. Bank Corp at 111 or 11% year over year for increasing net income, 5.7% for revenue year over year, and 2.3% for free cash flow over the last 10 years. So pretty good growth there as far as the last couple that we've discussed. Now here, Umpqua Holdings, very nice triple-digit growth as far as over the last 10 years. Still double-digit growth in net income, free cash flow, and revenue over the last 10 years. So very healthy looking stock there. We have FULT Financials. The revenue is only up 0.07% year over year over the last 10 years. Let's see, 3.2% in free cash flow, and 13% in net income. So net income has been increasing. Its revenue not increasing as much, but they're finding ways to increase their net income after all their expenses and such. So free cash flow is also up there. Next is Town Bank. Positive revenue, 27% year over year in growth there for revenue, 26% net income, and 6.5% free cash flow. Good looking there. These little dips here in free cash flow, these could be acquisitions or really high payouts. If we include the dividend there, they could be nice dividend hikes. You can see that this stock has been paying out dividends for quite a while here. Since at least 10 years. You can see that blue line here is that dividend, and it's up. Let's see, dividend percent is up 106% over the last 10 years. That means that generally over the last 10 years that they've increased their dividend by 10% year over year. So it's a very healthy dividend increase. Stantec, we can do the same here. Now this one's showing some negative numbers. That's because I added that dividend in there. Let me go ahead and remove that for now. So here, revenue up 214% over the last 10 years. That's 21% year over year. Net income up 173%, 17% year over year. You can see as of 2015, this one has started to kind of come down along with its free cash flow. So this would be something to kind of look at. Why has it came down as of 2015 over the last 3 years? Its net income has been declining. So this could be a red flag to kind of look out for. And then a couple other things there. Ingridion. We have increasing numbers here, increasing free cash flow, increasing net income, increasing revenue, has continued to kind of go on that path upwards. The Hatchet Group, again, very nice steady growth. You can see 2008, they had a big dip here in net income, their revenue and free cash flow, but they quickly recovered here within a year or two. They came out of that recession here in 2011 and have continued to go up since then. So very quick recovery there. And then we have OFG Bancorp. We are up in free cash flow by 1.17,000%, 18% year-over-year revenue growth, and 9.6% in net income growth over the last 10 years. So all of these stocks, there's 13 of them, I believe, 2, 4, 6, 8, 10, 11. 11 stocks that have made the cut, and they all have that increasing revenue, net income, free cash flow, price earnings ratio less than 25, and dividend yield greater than 1.2. Now, if we want to take a look at their dividend over the last 10 years, this is actually something a little bit interesting. Lincoln has increased their dividend by 21% over the last 10 years. Average increase per year is about 21%. You just take it, divide it by 10. Well, this one, for example, was actually, no, that's 10. Okay, so 21% dividend increase year over year, 10% dividend increase year over year, 7.5% dividend increase. You can see this one cut their dividend in 2008 during that recession period. They did cut their dividend there. U.S. Bancorp, they cut their dividend. They actually have decreasing numbers here. So they've actually decreased it from their top point here back in 2008. UMPQ Holdings, they're only up 0.05%. They cut their dividend here, not very steady. We have Fulton, again, cut their dividend. They may have done some special payouts here. That's why some are higher or not. We'll take a look at that here. Town Bank, it looks like they didn't cut their dividend between the financial, that crash that took place. But at the same time, it looks like they did cut it. So huge cut from 2007, ginormous cut. And then over the last 10 years have kind of steadily increased it out of that recession here. Very unsteady dividend stock. If you're looking for steady paying dividend stocks, these ones here towards the bottom are not recommended. So I do have them in the list. So the way that these are ordered here, these are actually the way that I'm going to be presenting them over at dividend.com. But we'll jump to there in just a second. So the next thing I want to show you is their price, their dividend over the last year. And we can see that I'm going to go ahead and change it back to data format, regular. This one is currently trading Lincoln Electric with a yield over price. So this one currently could be potentially undervalued just because it has came down as of January off its highs for the year, for the 52-week high. And it's currently trending more towards its 200-day moving average. So you can see here its 200-day moving average here is in the red. It is currently trading below. So it could bring back, it could come back up to that $91 point. It's more than likely to stay or begin to trend sideways depending on their earnings. Republic Services here. You can see that their price is above their 200-day moving average. Their yield is almost at some lows that they've had over the last 52 weeks. State Street Corporation. This stock is currently below its 200-day moving average. Yield is not at all-time highs, but still pretty good. Buying opportunity there. You're more likely to kind of trend sideways or maybe have some sort of growth than decline into the negative just based off that 200-day moving average. Definitely want to look into that stock over its financials, its balance sheet, moat, what services, products does it have, and such. Here, U.S. Bancorp. Yield over price. Price has came down. You know, financial stocks in general, JP Morgan, Goldman Sachs, Wells Fargo, many of those big financials, they haven't done very well going into the year. Even with rising rates, they've still been on the decline. So this could be a buying opportunity here. Trading below the 200-day moving average. You're getting a very high dividend yield, not the highest, around 2.4, but still 2.3 is a very good buying opportunity for the year. Umpqua Holdings. Yield at nearly lows, price at nearly highs. It's trading pretty good above its 200-day moving average. This one could be a kind of like a risky buy. You don't know whether it's going to come down due to earnings back down to its 200-day moving average, or if it'll just kind of continue to trend upwards slightly. This one's more likely to come back down to its 200-day moving average than continue on its highs. Here, yield over price, trading below its 200-day moving average. Fulton Financials. Town Bank here. It's trading above its 200 moving average slightly. This one's more balanced. This is probably one of the more balanced once its yield had been up nearly in the 2% range. It's now more balanced here in that 1.6% range. Not quite at the lows, not quite at the highs. The stock itself is not trading too high off its 200-day moving average, so it's right there, pretty balanced here. We have Stantec price below its 200-day moving average. Yield is over the price right now, so this could be a good buying opportunity. Definitely, again, want to do your research. What does it have going for as far as products and services? How strong is the moat? How have their earnings gone, their 10K, their yearly reports, and who are their competitors and such? Always a little bit more research. This just gives me, I took 30 minutes to screen 68 stocks. I was left with 11, and now this whole process, now I have 11 stocks that could be potential good buying opportunities. And these stocks right here, 95% of these stocks that I've screened, I would have never even heard, because many of my friends, the media, other investors don't really cover them or really research them, because it takes such a long time to go about individually screening a stock. Whereas in this video, I screened 68 stocks in less than 30 minutes. And now, based off their financial metrics, I can go a little bit further, take a look at their balance sheet, take a look at what products and services they use, take a look at their history, and so on. So I can go a little bit deeper dive just individually into these 11 stocks. Here, not too high above its 200-day moving average. You can see 200-day moving average has been coming down slightly, but it has been picking up here as of March 2018. Yield is a little bit below. It's actually kind of like mid, so not too bad there. And then we have OFG Bancorp. This one has shot up huge as of April. So this one may have had some really good earnings. But you can see as of October, November timeframe in 2017, if you had bought this stock, you would have bought it in the $8 range. It's now up at $14.50. Now at that time, you can see that yield was over the price by quite a bit. It had been trading below that 200-day moving average. That's why I like to look at the moving average. I like to look at its current price, its current yield, and of course, its net revenue, net income, and free cash flow. I could also bring in some other numbers here as far as like PE ratio. Current PE ratio would be in the blue, futures in the orange. We want orange in the bottom. That just means that, so this one, for example, orange is on top, meaning that their earnings going forward may not be as high. They're not expected to be as high. They're actually expected to have less earnings, which would cause their price earnings to grow. So this one, for example, this could be a little bit risky if they don't, if they flop out on a future earnings. Orange is below. That's good. Orange below, and kind of go through these. So you can see here, I just flipped through them very quickly, and I can see already that the only one here that traded with the orange over the blue was Republic Services. So there's a couple other things I could do here, such as price to book and price to sales. We could look at that. Some people like to look at 3s or 1s, see how close they are to a 1 for price to book and price to sales. A 1-for-1 would mean that they're currently priced at their sales ratio, how much they're selling, or how much their book value is. So this one, for example, has a little bit higher book value than its sales. Their numbers themselves, these aren't comparable, but it's good to have them trading pretty close here. You can see price to sales is at 2.3 and price to book at 2.8. Anything below a 3 is actually considered a pretty good value buy. So this one, for example, RSG, pretty good value. Straight Street Corporation, near or below a 3, near or below a 3, a little bit above a 3 here, but below a 3. They're very close to a 1.0 here in price to book. This is UMPQ Holdings Financial. Below a 1.5 is always good for financial institutions to have below 1.5. This one's a little bit higher than 1.5, but you can see it did come down into that 1.5 range, has been kind of growing steadily, same with their price to sales. Stantec, very low price to sales ratio, 0.8. So this one, for example, its price right now is priced below its sales point. So they're actually making more in sales than the stock it's priced at itself. And its price to book value is only at a 2.0 nearly. So that's actually a great buying opportunity. We already looked at its revenue, net income, free cash flow. It's expected to, going forward, have better earnings, decreasing its price to earnings ratio. It's also trading below its 200-day moving average, I believe. We can take a look at that really quickly as well. Yeah, it's trading below their 200-day moving average. So this one itself, besides their dividend being all kind of wonky over the last 10 years, this one could just kind of change it. It could be a fluctuating one based on their earnings. I'm not sure what STN or Stantec does, but we can do that. We can look into it here in just a second. We have INGR. Let's go ahead and bring back our price to sales and PE, or price to book. Again, under 3. Very good looking stock there. Nearly under 3 here. Here's a 1.8, 4.1. So these are actually very low numbers. 0.8 again there in price to book, and price to sales is only at a 1.9. So again, very good looking stocks as far as price to sales and price to book across the board there. Very healthy looking stocks. Now, the way that these are ordered, I had them ordered over on Dividend.com, and they're ordered with the highest dividend growth. So ticker symbol LECO has had 14 years of dividend growth. And you can go ahead and quickly take a look here. What you want to notice is the payout ratio. If they were to lose 50% of their earnings, what would their payout ratio be? Would it be over 100% payout ratio? If this one was to lose 50% of its earnings, its payout ratio would still be below 60, barely, it would barely be at 60%. At 32.9 right now, if you doubled that, that would be 64, 65. So very good payout ratio. Dividend yield, or the ex-dividend date is here, June 28th. That is next Thursday. You would have to buy it on Wednesday or prior. You'll then get paid out on the 13th of July. So this one is the only stock that has had dividend growth since, prior to the crash. And what they had did is prior in 2004, they had actually locked their dividend. So here in 2008, during that recession period, they locked their dividend out until they said, hey, you know what? We have really good earnings. We can go ahead. We didn't cut the dividend such as General Electric has done. We just froze it, and we're going to reward the shareholders that have held out. We did a stock split 2-for-1. So if you had 100 shares of the stock, let's go ahead and bring out our handy dandy calculator. If you owned 100 shares of the stock and they did a stock split 2-for-1, so for every one that you had, you now had 2. That's a multiplier of 2. You were also getting paid out 15 cents before. They said, hey, we're going to continue to pay out 15 cents. You multiply that by 0.15, and you got paid $30 instead of $15. So they basically just doubled your dividend pay. So that's something to look at here and below in the charts if you use Dividend.com or some other website to look up that information. For public services, waste management, 8 years dividend growth. Again, payout ratio less than 90 if you were to double it. Dividend yield 2%. Ex-dividends on Friday. You'll then get paid out on July 16th. Again, if you look at the dividend ex-dividend date, you have to buy these the day prior or before that. So here, Friday is the ex-dividend date. You would have to buy it on Thursday or prior, and then hold it until Friday, and then you could sell it off and still capture that dividend. State Street Capital. Dividend growth 7 years. Payout ratio very low. You could double it very easily and have more than 50% of your earnings still to reinvest into the company. Friday's the ex-dividend. You get paid out on the 17th. So this one, 2011, let's see just really quickly, for example, you can see here in 2011, they just cut the dividend. They cut it from 24 cents all the way down to a penny. So if you were an investor in that group, in this stock, you'd probably see a very, if they were a dividend investor, they may have cut that stock out of their dividend altogether. So let's go ahead. We could take a look really quick. What happened to their price during this time frame? So did their price come down? Yeah, their price came down very hard, whereas LECO, who paid out dividends during this time, actually their price came down pretty hard as well. They didn't fully recover from that recession point in 2008-9 until looks like a little bit after 2012. But you can see here that these other ones have had longer periods. They took quite a while to recover from that recession period of 2009. This one didn't recover for at least, let's see, 5 years. So something to take a look at there. Now, I don't know if I use General Electric in my example, but the reason I like to use revenue, free cash flow, and net income is for 10 years, if you had seen General Electric doing this over the last 10 years, like decreasing free cash flow, decreasing revenue, decreasing net income, this one's losing 3.2% revenue per year. This one's losing 8.6% free cash flow per year, and it's losing 13% of its net income year over year. That would be a bit of a red flag. That's why I like to look for stocks that have had, continued revenue, continued net income growth, and I like to have that free cash flow just in case, their earnings drop. They need to pay out their shareholders with their free cash flow. That's just extra cash. That's how they pay out their dividend investors. So I like to invest in healthy looking stocks. Ticker symbol USB, US Bank Corp, Midwest Banks, decent yield, 2.32, great payout ratio, dividend growth the last 7 years. Ex-dividends on Thursday, you'd have to buy it on Wednesday or prior. You would then get paid out on July 16th. We have Umpqua Holdings, ticker symbol UMPQ, another bank. Payout ratio a little bit higher. If you were to lose 50% of its earnings, they might be more likely to cut their dividend. So here, I don't know if we had looked at this. Let's see here. Yeah, we can see they cut their dividend here because their earnings fell. That recession period there kind of fell. And I think we already covered Thursday. You got to buy it Wednesday or prior, 16. FULT Financial, 7 years of dividend growth, 2011. So you see these spikes here after 2011. So they've had 7 years of dividend growth, pretty good payout ratio, pretty good dividend yield at nearly at 3%. Now if we come down here, I'm going to go ahead and tell you we probably have some special payouts. So here we have some special payouts. So it dropped so far, these little depressions, these are just special payouts to their shareholders. Hey, we had some free cash flow. We're going to go ahead and reward our shareholders 2 cents per share. Not amazing, but it's just extra money that they're paying out to their shareholders. They can take that money, reinvest into the company, buy more shares. I'm a dividend investor in my wife's Roth IRA. I have Apple in my IRA, and I have a couple other stocks. I own the S&P 500 in my thrift savings plans, and I have the large stocks within my Roth 401k. So I'm kind of diversified here and there across different platforms. Town Bank, ticker symbol TOWN, another bank, 1.91% yield, 6%, 6 years of dividend growth, very low payout ratio. This one's on Thursday. We'd have to buy it on Wednesday or prior. You'll then get paid out on the 10th of July. Again, they cut their dividend. So the best one here, I'm just going to go ahead and just share the rest of these. So Stanton Inc. USA, ticker symbol STN, technical services, yield, good payout ratio, dividend growth for the last 5 years, ex-dividends on Thursday. You would then get paid out on the 12th of July. Ingredient, processed and packaged goods, 30% payout ratio, so good payout ratio. Dividend growth 5 years. Now sometimes they may have like a dividend growth for 5 years, but what the company may have done is they did a stock split. I don't think we're going to see that in any of these examples here. They did do a stock split here way back in 2004, but here they did have a cut period where they cut their dividend and just discontinued it. I'm trying to see if I can find one that did a stock split, and instead of cutting their dividend, they just continue to pay it out. I don't think I'm going to find any of them here. Yeah, but let's see, where were we? And let's see here. Let's go back to the top, and top. Okay. Next was the Hatchet Group. I didn't even bring that over here. Let's go here. Now we can see it. Okay. Tickers, dividend yield 2.08. Payout ratio 37.8. Dividend growth 4 years. Thursday ex dividend. You had to buy it on Wednesday or prior. You would then get paid out on the 11th of July. Oriental Financial Group, bank company, 1.66% dividend yield. Very low payout ratio. Could double it, and then you'd be pretty good. Dividend growth at 4 years. Ex-dividends on Thursday. You'll then get paid out on the 16th of July. So those are the stocks this week. 11 of them. What I recommend, there were a couple in there that I would recommend checking out that were trading either near or below that 200-day moving average. They also had great, increasing revenue, net income, free cash flow over the last 10 years. Some were really good, really priced great for the price to book, price to sales, increasing PE ratio over the next couple quarters. So those are the ticker symbols. I will have them in the description below if you guys are interested in the stocks that have made it through the screening process. And that is it for this video. If you guys did enjoy the video, remember to like, comment, subscribe, share with your other friends who are also dividend investors if they're looking for stocks that could be great potential buys. If you did not like the video, go ahead and let me know in the comment section below what I can do to improve the video, the content. If there's a financial metric you would like included. I use these very quickly because I am able to screen roughly 70 stocks within 30 minutes. I can then go on to the next stage of doing more research, looking at their balance sheet, how long they've been paying out dividends for, payout ratio, what's their moat, what's their industry, their sector, what products, services do they use, who are their competitors. So that allows me to just quickly grab, instead of 70 stocks, I now have 11 and can do much more, much faster with that. So that is it for this video. I've already covered all that. As a quick disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion. For entertainment and fun, this is not investment advice. This is just me as a financial investor trying to help others make their money work for them. So thank you guys for tuning in. I will see you next time. Have a great day. Bye.